Hello everyone, I am Rinku, working as an assistant professor in Department of Management in RPIIT Technical and Medical Campus. Today we are discuss about the topic profitability ratio based on investment part 2nd. These ratios are calculated to measure whatever the business earning adequate return on capital investment or not. The business raise the fund from various sources. It is necessary that as a business unsatisfactory return of investment. These ratios are: first one, return of shareholder investment or net worth ratio. Second one, return of equity capital. Next, return on capital employed. Next, dividend yield ratio. Next, pricing covering ratio. Next, dividend payout ratio. And last one, earning per share. First one, return on shareholder investment. Shareholder investment, also called return of proprietor fund, is ratio of net profit to proprietor fund. It is calculated by the prospective investor in the business to find out whatever of the investment would to worth making in term of return as comparing with the risks involving of the business. Return of shareholder investment is equal to net profit after sale and deduction divided by prospective and prospective fund. Return on equity capital. The ratio establishes the relationship between net profit available to equity shareholder and the amount of capital invested by them. It is used to compare the performance of company equity capital with those of other companies, and they have help of investor to choosing a company within the higher return of equity capital. Dividing return on capital is equal to net profit minus preference shares divided by equity share capital and paid up capital. Return on capital employees. These ratio most appropriate indicate of the earning power of the capital employed in the business. Return on capital employees is equal to net profit before tax and interest divided by capital employed. Ideal ratio is 15%. If the actual ratio is equal to the abnormal 50%, in the indicate higher productivity of the capital employed and vice versa. Dividend yield ratio. It refers to the percentage or ratio of dividend paid per share and market per capital. This ratio throw light of the effective rate of return on investment which potential investor may hope to earn. Dividend paid equity capital divided by dividend yield capital market price per equity capital. Price earning ratio is show how many time an annual earning the present shareholder is willing to pay to get share. This ratio help investor to know the effect of earning per share on market price on the share. The ratio when calculated for the survival year can be used as term analysis for predicting future pricing, earning ratio, and therefore future stock price. Price earning ratio is equal to average market price per share divided by earning per share. Dividend payout. This ratio indicates the proportion of earning available which equity shareholder actually receive in form of dividend. Payout ratio is equal to dividend paid per share divided by earning per share. An investor primarily interested should invest in equity share of a company with the high payout of ratio. Earning per share. This ratio indicates the earning per equity share. It establishes the relationship between net profit available for equity shareholder and the number of equity share. Shareholder equity ratio. Earning per share is equal to net profit available for equity shareholder divided by number of equity shareholder. Thank you.